One of the main issues that I told you may struggle with in this chapter is the concept of revenue being recognized when earned, not necessarily when we receive the cash, and expenses being recognized when used, not necessarily when paid. So let's take a minute to talk about the difference between cash basis accounting, where it's all about the money, and accrual basis accounting. So with cash basis accounting, we record revenues when cash is received and expenses when cash is paid. That makes life pretty easy. Revenue is simply equal to the cash received. Expenses would be equal to our cash paid. And then our net income would be the difference between the cash received and the cash paid. The cash basis sometimes is adequate for organizations that don't need to report to external users, such as small businesses. The IRS allows small businesses to report on the cash basis and pay their taxes on the cash basis. But cash basis accounting can lead to the incorrect interpretation of future company performance because it's really dependent upon timing, when we get the money and when we pay it. We can easily manipulate our income simply by not paying our expenses until the next month. That'll make the income for the current month look better. We can entice customers to prepay for items that they're going to buy in the future to make our income look better in the current period. So it really is not the best way for companies to make decisions and to inform their users of their profitability. And that's why GAAP does not allow for cash basis accounting. Sometimes an example is better than words, so let's take a look at an example of cash basis accounting. We have cash receipts from our customers that are coming in at different times. So we have 20, then 70, then 90 for a total of 180. And then we have our cash disbursements for our employees, consistent from year to year. But then notice that we pay insurance 3 years worth all in year one. And then we pay supplies at different times in year 1, 2, and 3, even though we may use those supplies evenly throughout the 3 years. So using cash basis accounting, in year 1, investors would think this company is failing. They're losing money. This isn't a good company to invest in. Then all of a sudden, year 2, things turn around, and then year 3, it looks even better. And that's just because of the timing of the cash coming in and cash going out. So using cash basis accounting may lead to an incorrect interpretation of the company's future performance. In year 1, we may believe that this company has no future because they're losing a significant amount of money. So looking at the first year, investors and creditors might interpret those negative cash flows as a problem with the company, when in fact it's just a problem with timing. The customers are not paying us right away, and that gets taken care of in subsequent years, but we wouldn't know that if we were just looking at 1 year. To better make the point, let's compare this same company using accrual basis. So we have $180,000 in sales. If we use the accrual basis, we record them when we sell it, not necessarily when we get the money. So you can see that 180 is broken up into 60, 60, and 60. We sold the same amount of product each and every year, and under accrual basis, we would record the revenue for the amount we've earned each year by providing the good or service, whether or not we got the cash. The employees' salaries are the same. We pay and use those employees equally each year. But notice the insurance now, I broke it up over 3 years. So the $12,000, though it was paid in year 1, is broken up into 3 different years because we use up 1/3 of it in each year. And then supplies, likewise, I took the $15,000 in supplies and broke it up evenly over the 3 years. The ending result is under accrual basis, this company is earning a profit of $21,000 in each year. So that's a much different picture than what we had before under cash basis. If I go back to the previous slide, where we're losing a whole bunch of money and then making a bunch of money in the later years. So first we lose a bunch, then we make a bunch. That's really not giving users of the financial statements an accurate picture of what's going on with this business. What's really going on is the company is consistently earning a profit of $21,000. You'll notice in total, the numbers are all the same. So the revenue is the same as the cash receipts, 180. And the expenses, 90, 12, and 15 are the same in total. There's the 180, the 90, the 12, and the 15. And you'll notice that the income under cash basis and accrual basis over the 3 years in total is the same 63,000. See? 63. It didn't change. But the picture of the health of the entity is different based on using cash basis or accrual basis, because cash basis focuses on timing as opposed to when we provide the good or the service. So accrual basis provides a much more accurate picture of how the business is doing each and every year, and it doesn't get impacted by timing of payments. The fact that customers may have paid us a little late, or the fact that we may have prepaid some of our costs. That is not accounted for under cash basis. So with accrual basis, we're smoothing out those earnings to better reflect reality. So let's take this discussion of accrual basis a little further. So remember, with accrual basis accounting, revenues and expenses are recognized when the transaction that causes them occurs, not necessarily when cash is paid or received. Again, revenues are recognized when earned, expenses when used. If we were in class, I would have you repeat that. Revenue recognized when? Earned. Expenses when? Used. Revenue earned. Expenses used. Okay, you got to get that through. You have to understand that concept. Accrual basis accounting requires or is required by GAAP. So this is the method we will be going over in class. It is the best method, the most preferable method to provide users with useful information for decision making, which, remember, is the fundamental goal of financial accounting. So with the revenue recognition principle, when do we record revenue? When it's earned. How the hell do you earn it? By providing the good or service. So we may receive the cash before we make the food delivery. We may receive the cash when we make the food delivery, or after we make the food delivery. But that doesn't matter. When we're determining when to record revenue, the answer is when we deliver the food, because that's how we provide the good or service. So let's go through some examples. If cash is received before we deliver the goods or services, then a liability is created for the business because they haven't earned it yet. They haven't provided the good or service yet. So under our accounting equation, we have A equals L plus C, and in this chapter I'll be expanding it to include the income statement. What happened is cash go up, and then our unearned revenue liability go up because we owe them food. In journal entry form, the cash goes up with a debit if you go back to your conversion guide from chapter 2, and liabilities go up with credits. So no revenue's been recognized at this point. We haven't provided the good or service. We got your money, so cash goes up, and we owe you food. And that's why we have an unearned revenue liability that goes up. Remember the debit and credit rules? Nice and easy. All you got to do, focus on the conversion guide. So first we talk English, cash go up, liability go up. Then we convert it using that conversion guide. What happens when we deliver the food? So when we deliver the food, we've now provided the good or service. So our revenue would go up because we provided the good or service. That makes our net income go up. And remember, net income is always going to affect our equity, specifically retained earnings, because the only way you retain earnings is first by earning it through net income. So whatever happens to net income is always going to happen to our equity, and that's how we're going to maintain our balance sheet balancing. If we've earned the revenue, the reason we've earned it is we provided the good or service, so we no longer owe it, so our unearned revenue would go away. So first, cash is received before we deliver the goods or services, so we have an unearned revenue that we owe. Once we deliver the food, what happens? Well, our unearned revenue liability goes away. Using the conversion guide, that's a debit to make it go away. And then our revenue goes up because we've now provided the good or service, and revenue goes up with a credit according to our conversion guide. Notice that the revenue is also going to affect equity, and that's because revenue makes net income go up, and net income affects retained earnings, which is part of equity. That's always going to happen. Anytime net income is affected, you're going to have equity affected. That arrow always holds true. So that's why I always set up my accounting equation with my balance sheet and income statement, because whatever happens to net income on the income statement is going to affect equity. And then our balance sheet is still in balance because we're up down on the liability and equity side, so the net effect is 0 on the assets and 0 on the debt and equity section. So we're still in balance. So what happens when cash is received in the same period as the goods or services? Well, this is the easiest scenario. So we have A equals L plus E, revenue minus expense equals net income. If we provided the good or service, revenue go up, which makes net income, and therefore equity go up. And then if we get the money, at the same time, our cash goes up. So again, our accounting equation works. We're up on both sides of the equation. And to convert it to debits and credits, cash go up with a debit according to our conversion guide, and revenue go up with a credit. Revenue will affect equity, but notice in our journal entry, we're using the revenue account. Likewise, when we talk about expenses, we'll be using the expense accounts. So they will ultimately affect equity, and we will learn how we actually move the amounts into the equity account in Chapter 4. But for now, you just have to understand that whenever we're recording revenues or expenses, we use the revenue or expense accounts, T accounts, so we can track the values in those accounts. Eventually, it'll all get shoved into equity, but that won't happen until the end of the period. So again, setting up our accounting equation allows us to first think English, what go up, what go down, and then we would convert it to debits and credits. The last conceivable scenario is we provide the good or service and then get paid for it after. So when this happens, if I do out my accounting equation, if we provide the good or service, we earn revenue, which makes net income go up, and in turn, equity go up. But if we didn't receive the money yet, we have an account receivable asset that would go up because the customer owes us money, which is a future benefit. To convert that to debits and credits, receivables go up, assets with debits, and again, revenue goes up with a credit. Then what happens? Well, later on, we'll get the money, and when we get the money, all that happens is our accounts receivable would go down and our cash asset would go up. So when we get the cash, our receivable goes down with a credit because assets go down with credits, and then our cash goes up with a debit because assets go up with debits using our conversion guide. So we're not earning any more revenue at this point. We record the revenue when we provide the good or service. So when we get the money, all that's happening is I'm getting cash in exchange for a receivable. No new revenue is being earned. You don't want to double dip. The Financial Accounting Standards Board and International Accounting Standards Board issued joint recognition standards that became effective in 2018, and it involves 5 steps in recognizing revenue. You don't need to memorize these steps for the purposes of this class. Remember, our focus is more simplistic. Revenue is recognized when earned, which is providing the good or service. But in the real world, it can get more complex. For instance, if you buy an iPhone and along with that you get Apple Care, you're paying an amount for both, and the business has earned all of the revenue related to selling you the iPhone as soon as they give you the iPhone, but they have to provide service for the Apple Care over 1 or 2 years, so they don't earn all of that revenue right away. So when situations like that happen in the real world, companies need to figure out a way to allocate the revenue between the various obligations, the promised goods or services. In our example, it would be the iPhone and Apple Care. We're not going to get into that level of complexity in this class, but I think it is important to realize that not everything in the real world is going to be quite as simple as we try to make it out in our class. So please be aware of that. Now we're going to move on to the expense recognition principle. It's also called the matching principle because we are matching the expenses in the same period as the related revenue. There's 3 scenarios here that can happen. We can pay cash before we use the expense. We can pay cash at the same time we use the expense, or we can pay cash after we use the expense. So let's go through all 3 examples. So if cash is paid before the expense is incurred, what's going to happen to our accounting equation? Well, let's write it up. If we paid cash, cash is going to go down, but if we haven't used the expense yet, we get a future benefit because we're going to get to use it in the future. So we call that a prepaid expense, which is an asset. You may remember from way back in chapter 1. So at the time we pay, our asset go up. In this case, we're paying supplies, so we haven't used them yet, so we've got supplies in the supply closet. So the asset goes up with a debit according to our debit credit rules in our conversion guide, and then the money go away. So all we're doing is exchanging one asset for another at that point. Then when we use up some of the supplies, that's when we record the expense. So when we use it up, our expense go up, our net income go down, which in turn makes our equity go down, and then our supplies, which is the same as a prepaid asset, would go down. So if we use up half the supplies would go down 100. To make that happen, you credit it because that's what the conversion guide says you do to make assets go down. And then we've used it, so the record of what's been used is the supplies expense. It's simply a record of what's been used. That makes the expense go up, but in turn, net income and equity go down. And that balances out our accounting equation because assets on one side and equity on the other both go down. When we use up the supplies, that is when the asset goes away. Up until that point, we had $200 worth of supplies in the supplies closet, so we had a future benefit from those supplies. When we use them up, they're now gone, so the asset goes away, and we record the using up of that asset with an expense. That expense decreases net income. Notice we use the expense account in our journal entry, not the decrease in equity, which is really the retained earnings impact. We'll shove those expense effects into retained earnings at the end of the period. And we'll cover that in chapter 4. So now the next scenario is we pay the cash in the same period as the expenses incurred. So this is the easiest scenario. It's one step. We use it, so expense go up, which makes net income and equity go down. And then we pay for it, so cash goes down at the same time. Easy peasy. So if we pay for repairs at the same time we get the service, then we've incurred a cost. We've used up the expense, so expenses go up. And then our cash goes down at the same time. Debit credit rules tell me expenses go up with debits and assets go down with credits. So that's why my debit and credit looks the way it does. Now I understand, as I say, we use the expense. Some of you may think expenses should go down. But remember, using the expense, an expense is just a record of what's been used over time. Imagine getting your cell phone invoice. And the more months that go by, the more and more invoices you have. Those just papers, those invoices are the expense. It's a record of what you've used over time. So expenses are just a record of what we've used up over time. We're giving up the asset as a result of incurring that expense. So it's not the expense that goes away. The expense keeps accumulating. It's the assets that go away when we pay for that expense. The last scenario would be cash is paid after the expense is incurred. So in this scenario, doing out my accounting equation, I incur the expense, so expense go up. That makes net income and equity go down. And then I didn't pay for it yet, so I have some type of payable that goes up. I owe it. I've used it, so I got to record the expense. Expenses are recorded when used, but I haven't paid for it yet, so I owe it. Journal entry form, if we have 400 in employee services that have been used but unpaid, we record the expense by debiting the expense to make it go up according to our conversion guide, and then we record an increase in our liabilities because now we owe the employees that money. They've worked for us, we haven't paid them yet, so we owe them. What happens after when we pay them? Well, our payable would go away and our cash would go away. Again, our balance sheet balances because assets go down and our liability on the other side of the equation go down. To convert to debits and credits, we use our conversion guide where we have our liability going down with a debit and our cash going down with a credit. Again, keep looking at that conversion guide because the first step is just to use common sense logic thinking. I first used my employees. Used equals expense. Boom, expense go up. I didn't pay them yet. I owe them then. Liability go up. Then when you pay them, what happens? Bye-bye money. Money go down. And then if you pay them, you don't owe them anymore, so your liability goes down. The conversion to debits and credits, you just look at your conversion guide, and it should be quite simple to make that conversion to accounting language. Recording revenues and expenses in the appropriate period is extremely important, and management a lot of times tries to record revenues and expenses in an inappropriate period to make the company look better than it truly is. And as we mentioned earlier in the course, ethics is extremely important in accounting because users are using the information to make decisions, and if we provide them with false information, they're going to make poor decisions and get hurt. So these are just some examples of various CEOs that were involved in frauds, recognizing revenues and expenses in the inappropriate period to make the company look better than it really was. When the fraud came to light, they were convicted, and the outcome you can see is quite a few years in prison for these different schemes. So it's really important that we remember to follow the revenue recognition and expense recognition principles, which in short are revenue recorded when earned, expenses when used. Again, practice makes perfect. So we've got to practice this material to really get it to sink in so we have a good understanding of what to do.